Great. Hi, everyone. Here for a very exciting panel with some of the people really driving forward the most important aspect of blockchain adoption, which is the buy side and asset management that's creating the demand that's fueling the adoption of blockchain technology by the capital markets and also in the public chain world. So excited to be joined by the accomplished panelists here. I'll let them introduce themselves, starting with Emma. Please go ahead.
Thank you, Sergey. Good afternoon, everybody. I'm Emma Pecenicic. I'm from Fidelity International. I have two hats at Fidelity, leading digital partnership and distribution for APAC, and as well digital assets globally. So yeah, I will go into more later.
Hi, I'm Andrew from UBS digital asset team, working on our UBS tokenized platform and leading a lot of the work around the fund tokenization for us, which we started last year.
Well, it's great to be here first. Thanks for having me. I'm Edgar Gehringer. I'm the CEO of HSBC Asset Management in Hong Kong. And I have about 24 years of experience in asset management, about from that 22 years in Asia.
Hi, I'm Andrew Crawford. I'm from Franklin Templeton. We're a US-based manager who manages about 1.7 trillion globally. We launched the first tokenized fund in 2021 in the United States. And yeah, we're a keen adopter and believer, and we're looking to the future and see blockchain as a key and integral part of that.
Great. Thrilled to have you here. So we have a lot of topics to cover, so let's jump in. So Andrew, what do you feel are the market forces that are leading to adoption by asset managers of fund tokenization?
Yeah, good question, Sergey. So I think there's been a big transformation this year with the bifurcation of crypto and blockchain. And crypto is the main asset that sits on a blockchain-based recording system or record-keeping system. What we see is now a lot more people are seeing the benefits, whether it be cost, efficiency, transparency, interconnectedness of operating on a blockchain-based system with a single ledger, and we see that's really driving, will drive the industry in the next 12 months and beyond very quickly.
So you feel it's the efficiency gains from putting a fund structure on a chain?
Yeah, I mean, we did a study where on the traditional way that we record a transaction, it cost us about $1 to do that. So for us to do 50,000 transactions on a traditional rail costs $50,000. 50,000 transactions that we've done on the Stellar network has cost us $120. So there is a huge cost saving, but then that cost saving also leads to efficiencies in the sense that you don't have to do the reconciliation of multiple ledgers, you don't have to remediate issues, everyone gets the same information synchronously. Yeah, so it's a real cost that we can identify the actual saving, and then these other benefits. We spend about $200 million a year on remediation and reconciliation. If we can move all the 1.7 trillion of our assets, currently we have about 500 million. If we can move that all onto blockchain, we will save $200 million, excluding the transaction cost, which will be 0.0025 of what they are today. So yeah, it's huge. It's just the big move is moving from a custodial model to a blockchain-based system where we don't have third parties like banks like HSBC overseeing. That's the big change that we have to. That's going to create the friction.
Okay, that's interesting. Thank you, Edgar. What do you feel are the market forces that are attracting you and your firm to using blockchains and fund tokenization?
Yeah, so we're a little bit different. We are a traditional bank. So moving a traditional bank into blockchain takes a bit more understanding of what the benefits of a blockchain actually are and what's the control of a blockchain. How can you control? How can you guarantee? There's a lot of concern about if there is an error or a transaction goes the wrong way, it could have a massive impact.
Yeah.
And it could reputationally really impact you. So there is a lot of concern about that, and thanks God, here in Hong Kong, we had the regulator actually coming to us and said, we want to do this as the regulator. We want to set up a sandbox with blockchain but we want you to put assets on it. We want you to go there and put on it. So that gave us the push to actually do this and go there. And we started off with a green bond and then with gold to tokenize, because there's a lot of transactions we do on gold. And we see clear future of going further that route, because if the regulator sees the benefit for the end investor, and it's about the end investor, it's not about us or the end investor. And if the shareholder, as you said, gets benefit because we can automate that reconciliation, that would actually really benefit the regulator, the shareholder, and it would give us managers to focus on what we should do, drive performance.
So, Andrew, how do you view the market forces, the reasons for asset managers to adopt fund tokenization?
Yeah, so I think about it in three driving forces. So one is maybe more on the supply side, so the asset issuance. So maybe start with that one. So UBS is involved in a lot of different tokenization initiatives under UBS Tokenized. So we've looked at different products like bonds, structured products, precious metals, et cetera. And I think anybody who's gone through that process understand that tokenizing an asset, there's a lot of kind of legal, regulatory, structuring considerations that go into it. And if you wanted to get all those assets on chain, you have to almost go asset by asset, jurisdiction by jurisdiction, to kind of figure out, how do I bring the register for this, online or on chain. So a fund gives you, in a way, kind of a convenient vehicle that standardizes the way that you do that, at least to start, while all these other kind of pieces of regulation are evolving. And so that was from the structuring side, I guess, one thought that we had, which is, this allows us a standard way to bring assets or investment content on chain. And then the second driver, which is, I guess the demand, like who's going to buy it. I guess the thesis being that if there's going to be more liquidity or cash moving on chain, whether that's in the form of tokenized bank deposits, CBDC, or even now kind of the stable coins, investment products exist to bring that liquidity through time. So the products that we create, we need a flexible platform to meet kind of the demand that might come in the future and be in the same format that people holding that liquidity are able to accept. So the tokenized product is a format that allows us to reach, let's say, the digital cash in all its different forms that could exist. And then the last one is, for us, some of the tokenized products, including the tokenized fund pilot that we had last year, is on a public blockchain. So we tokenized that on Ethereum, and that got us really thinking about the smart contract sitting at the center of the product, and how we could start using that almost like an API outside of the firewall, and seeing kind of what would people build or connect to the product if we were to kind of make it available. So I think these are some of the structuring kind of and market forces that have led us to thinking really about tokenized funds and seeing what more we could do with this product.
Yeah, so that's interesting. The simplicity of turning it into a tokenized asset, the efficiencies that creates, then more liquidity, more of a market. And then when you looked at doing it on Ethereum, you saw the value of composability with other protocols in the DeFi space. That was a valuable property that seemed attractive.
I think over time, as the space kind of matures, that would be an interesting path to see kind of how people can come together to kind of build on each other's products.
How your on-chain TradFi product can interact with other protocols and systems built on that chain.
Yeah.
Yeah, very interesting. Emma, how do you feel about the market forces that are driving asset managers to adopt fund tokenization?
On our side, we have a client-led, distribution-led approach where we're seeing basically two main new type of clients, two new channels, if you want. First, we have the crypto companies through the digital asset banks or the RWA tokenization platforms asking for more tokenized money market fund. That makes sense because you can see there are about 40 billion of assets sitting on chain that is not earning any yield today. So that's why we get that demand from the foundation, etc., to invest into tokenized money market fund. And then we see as well the rise of stable coins, right? And there's about 180 billion of stablecoin, more regulatory frameworks around stablecoins, and stablecoins need to manage their reserves. And in order to have, the liquidity of a stablecoin, you need to have tokenized money market fund on the back for the reserves, the transparency, the proof of reserve. So that's really the first client segment. Then the second client segment is a bit more long-term, and it's working, with large banks, our current clients, or even the digital platform, I would say the e-commerce online platforms. Ultimately, a wallet is the investment account of tomorrow, right? So all the assets will be sitting on-chain, so you need to bring fund on-chain, right? And you'll see more, the conversions, the massive crypto retail platforms starting to diversify with wealth management product. You see the traditional platforms wanting to bring digital assets on their chain. So ultimately, we want to be there, to adapt the wrapper of our funds to be able to target those new segments. And that's really relevant because often those clients are younger in nature. A millennial is 3 times more inclined to trust a crypto asset provider than a traditional platform. So ultimately, you want to be there to serve them where they are, right? Yeah.
Yeah, that's very interesting. And the thing about the millennials and the fact that they've kind of matured and have money to spend, and they have an interest in the reliability guarantees of crypto, and how that kind of crypto blockchain community is a target market.
Yes.
For the asset management industry is kind of a big shift in how the world sees that community, because that wasn't that way always.
And it's growing, and even the Gen Z, right? Often, the management is like, oh, we don't serve young people because young people have no money, right? You're not at the accumulation of wealth. But that's not true anymore, because in the survey that we see is that Gen Z and millennials save more than the older generation at the same time, and they invest more and at an earlier time. So, that makes the perfect, target segments when you are a long-term, have a long-term strategy like us at Fidelity. We are privately owned, right? So we can have a 10-year strategic view on, that client segment, really to cater for their needs with fund tokens.
And I think we don't know if the new generation of investors is going to follow the same patterns as the past generation.
Right.
And I think
they're more inclined towards crypto.
Well, I think they've got more information. There's no information asymmetry. You can get a lot more information now from the web than you didn't have to go to the advisor. And then we see things like machine learning and AI coming in, which will give you more advice. So we see that for us to survive and prosper, we've got to meet the new market where it wants to be, and it wants to. We operate 9-to-5 businesses. We have to transform ourselves so we can operate in a 24/7 business, which is where you have to operate on chain. And I think from our perspective, we see 99% of the TVL is locked in stable coins, NFTs and cryptocurrencies. There's no reason why people can't have actively managed, professionally managed funds made available to them.
Available
on their
to that user base. Yeah.
Yeah, we think that's we're working with we will do the first listed tokenized fund on a exchange here in Hong Kong. And we think that's giving, we don't see that stablecoins are a good proposition, that you give someone your money and they don't give you yield, because effectively inflation means that your purchasing power is less. So we just think fundamentally, if you don't want to speculate, if you want to risk off and park your money, you should earn the yield that, so your money is at least worth the same amount, with the inflation. We just think that's a valuable proposition for investors, and that should be made available on chain, and it's not today.
And it's more than that. When you think about Asia, you have India, you have China, such huge population, and there is not even a bank in certain parts of where these countries are. Even in India, you have every year millions of new people buying into asset classes, into asset management. If you
without a bank account. So they don't have a bank account,
but you don't need one.
But they have crypto, and they can buy into your asset fund structure and receive a yield they would have received historically from a bank account. That's what you're both saying, yes?
Yeah, I mean, you look at a country like the Philippines. Gcash has 85 million users. To get a bank account there, I think the bank account penetration is only 20%, but 90% of people have a digital wallet with Gcash. In that, they can purchase a wide number of investments, and those ledgers are kept together within the Gcash ecosystem. Pakistan, Bangladesh, Indonesia, these countries are skipping the bank, go to financial advisor, get financial advice, to literally go straight to the digital wallet. And that's
they're going payment network, crypto, on-chain financial product.
Yeah, that's
the journey.
That's the user flow that they're experiencing.
That will be the user flow. I'm not sure everywhere.
I think Andrew's saying that is now in some places.
In some places it starts, right? I mean,
we're working with a company that will be able to give our access to our funds on-chain to 1.2 billion people in Indonesia, Egypt, Nigeria. We could never have done that in the traditional methodology. So this is really opening up, giving us the ability to empower people, whether they're in Bangladesh or in America, to invest alongside the largest investors in the world with the same strategies and the same products. If you're someone in Bangladesh, you can invest side by side with CalPERS in exactly the same strategy. And for us, that's empowering people to get, and not paying huge fees to get there. That's a really phenomenal opportunity that has been presented to us by utilizing a blockchain record-keeping platform.
And the industry is shifting. You have big technology firms like Tencent in China acquiring an asset management company, or you have Amazon who could jump into asset management and put it on all the user connectivity they have, all the information they have when you do a transaction on there. So there is also a threat to our industry that big tech companies use this technology actually to get into the market, and they have a huge base there. So there is also a time for us to really, as Andrew said, to be there.
Got it. Makes sense. So just to understand, there's just another question, very specific, that we can kind of run through and get everyone's views. One of the things I'm trying to really grasp is, what is the user base that is attracting you, right? Is it the DeFi, public chain, consumer user base? Or is it the large institution, like TradFi, multi-billion, multi-trillion dollar asset under management counterparty? So just kind of quickly, starting with you, Emma, who is it that, the asset management industry doing all this fund tokenization is probably seeing as a more attractive initial customer?
Okay. Today, it's the crypto native community, right? So we have 2 tokens that have been issued, one by APACxJ in the UK, one by Sygnum in Switzerland, and you can access with those tokens to our institutional liquidity fund, UCITS fund being in Ireland, it's a money market fund, 8 billion money market fund, AAA rated, so that you can access yield on chain through those 2 platforms. So we treat APACxJ and Sygnum as clients of ours, and basically the crypto native community goes through APACxJ or Sygnum to assess this token. So that's the first one. And for us, that's the catalyst to do more, to start targeting, to change the operational processes so that we can serve basically the next generation of investor.
Okay, so it's the consumer Gen Z, millennial,
exactly.
Because it turns out that
exactly.
Young people have a ton of money. I can tell you for sure that in the crypto industry, young people have most of the money. The vast majority of it. It almost seems like the younger you are, the more of it you have. But that's a whole other thing.
We want to get there, but the regulatory framework to do that is not in place everywhere, I would say, so that you can get all the operational efficiency and the distribution capabilities that today we have in the traditional framework. So that's why we see, the crypto native institutions as a way to basically build our infrastructure and start, distributing.
Got it. So it's the crypto native, public chain, DeFi-esque user base, and the institutional user base is going to, come later? Or who cares?
I would say who cares, right? But ultimately, I think it's a journey, right? From crypto native institution to more younger generation, and ultimately, the institutions, right? Today, that's how we bridge, crypto finance with traditional finance, and then we have the crypto ETF that, we have ETPs that are doing the opposite, bringing the institution into crypto, right?
So the traditional fund structures are how you think the traditional institutions.
Yeah.
Until they're all on chain, then maybe that'll change.
Exactly.
Okay. Andrew?
Yeah, I would say, echoing a lot of the similar thoughts, it kind of is also driven a bit by the technology choices. So if you're going to go onto a public chain, again, an investment product only makes sense if it's bring liquidity through time. And so the liquidity that exists on public chain is mainly digital asset, kind of more digital native investors. I think that is kind of the more immediate opportunity. And then over time, the traditional investors, some of the stuff that you're building in this new infrastructure, you might be able to kind of bring in and offer that as an efficiency to the existing segment. But I think that existing segment is pretty well served today. So it's just really a question of the timing of when them happen. But I think they're both going to eventually kind of move on chain. It's just a question of when.
So your vote is also crypto native. Get the crypto native money into the tokenized fund structure, and then if it works out, offer it to the institutional user from there. Is that the gist of it?
Yeah, and I would say, but to Emma's point, because these are securities, so in terms of reaching investors and kind of operating that kind of compliance, aware regulatory environment, there has to be, I guess, a lot of careful thought into how you kind of do that go-to-market. I think what's helping in that path, especially in places like in Hong Kong here in Singapore, is that you are seeing kind of more licensed and regulated firms that have the ability to potentially distribute these types of products, but also the tech base that is the same as, let's say, a crypto native company. And so you have these potentially interesting set of partners that you could start to think through, as I think Emma mentioned some of them as well, that you could start seeing how to tackle that in a way that would be consistent with a more traditional institution. Yeah.
Got it. Makes sense. Edgar, DeFi, degen, or institutional TradFi user, who is the one that has the most attractive user base right now for the tokenized funds?
Yeah, so we thought originally it is the public chain. It is the public where you go and you offer it to the user base. That's what we originally thought. And we don't do crypto. We stay on the traditional side. But having said that, if you read research and you look at what the research institutions are saying, where really the leverage will be is when high net worth investor or big institution are diversifying some of their investment into what we would call then you have a real blockchain setup. And why would they do this is because, of course, there's a lower cost. It's clearly a lower cost. With a lower cost, you can offer a lower management fee. And that means that the return is there. And then if you have the entire ecosystem from blockchain to Gen AI, your investment professionals can get a huge amount of data processed much faster. And because they can process it much faster, you can do in a fund performance alpha much faster, because you can faster go find out what's actually in the research happening, and you can faster make a decision. So we see actually over time, we believe that there will be a shift going to high net worth and institutional investors seeing this as an opportunity because of driving efficiency, cost, and outcome.
Makes sense. Thank you. So in your case, institutional adoption is the place you see the majority of the adoption for the efficiency and the other various benefits and a better financial product. Andrew, what is your vote? DeFi, degen, or institutional TradFi?
We're following the money. So 75% of traded TVL is done by institutions or institutional investors with more than $1 million. So our key priority there is to build infrastructure, to bring safety and soundness, and there's a number of large institutional investors who are sitting on the sidelines. They don't like the risk of having their money with an exchange. They don't like the liquidity. And if they want to go short, they don't want to use perps. They want to use physical. So we're building the infrastructure to enable these investors to have their collateral managed so they can mirror that on an exchange. We're also doing lending of coin so they can go short. So we're building the infrastructure for them, and we see that's a very that's going to bring a lot more liquidity to the market. The other one we're attacking is trade finance. We see the use of a smart contract with an escrow account and the transparency you get, integrating that with something like CCIP, where you can see, where the vessel is, when it reaches a certain mark, that may interact with another, go to the Oracle and get more information. We have this event-driven smart contract, and then when the contract gets to a point, then the money passes from the buyer to the seller. We see that's huge. We see that banks have really dominated that market, and as you go to the developing market, the costs are exorbitant. And we see that there's a lot of infrastructure being put in place where there's a large group of people that do not want to dollarize, they want to de-dollarize their trade, and they don't want to use a SWIFT network. They want to use a network because when Russia was removed from SWIFT, that sent a lot of concerns to people, and they like a decentralized payment system such as a public blockchain. So we're catering to build a trade finance model which does meet those needs. I think the other one that we're very focused on is, people who are on an exchange. So let's take, for example, OKX. If you want to risk off and you don't want to, you want to just take a bit of, focus off the market, but you want to earn the yield, you should be able to do that on your exchange. And I think we also see those people are going to be building more, they're going to be having financial goals, and they're going to execute those on those exchanges. They like the exchanges. The usage of crypto exchange apps is 4 times what bank apps are. So there's something there they like. So why don't we give them the ability to control their financial life there? And then I think the fourth one is really giving access to people who have not had access to high quality products that will,
retail people.
Yeah, give it that empowerment. So there's 4 areas, and we're going after all 4 of them actively.
So Andrew's answer is everything. Everyone. Everyone's going to be on the funds, which makes sense, right? So the institutional users, because of the benefits, something through trad finance, something through exchange accounts, and then also retail public chain users. So I think your view is pretty developed. My view is also that it's everyone. It's just at what rate does the trad finance use case evolve versus the institutional user versus the public chain user? I think the public chain user is here today, and the growth in the crypto market into the past, 2 trillion, I think made it an inescapable kind of market. The asset management industry had to take seriously. And so I think that's a very logical and clear and simple, answer to that. There's a market there, but in the case of institutional users, it's case by case. And I also know asset managers differ about the user base they traditionally cater to. So I think the user base they traditionally cater to, once that user base adopts blockchain technology, then the asset manager will be like, oh, wow, okay, my user base is interested in this. Time for me to keep servicing them. That's kind of like the millennial Gen Z thing we just talked about in the case of the asset manager that cares about that.
But a lot of this came about, a lot of the catalyst for this, Sergey, was FTX. I think that really catalyzed a lot of people's views that, we have regulations, we have rules, we have, structures, risk management structures, and we have large, old, boring institutions with people like us who wear suits, unlike the previous panel where everyone wears a T-shirt. We actually do have a role to play. We actually do have we actually bring that safety, that soundness, that experience, that fiduciary responsibility, that understanding of the risk. We are there on behalf of the client to do what they expect us to do and to hopefully give them more back than they expected. And I think what FTX did was said, money's hard, money's very easy to lose, but very hard to make. And I know these guys are boring, and they're predictable, but sometimes I don't mind that. I want to have that trust, and I think in a very decentralized market where you don't have a lot of people overseeing, something as precious as money, you actually want people you can trust, and who have, we've been going for 75 years, HSBC 150, UBS 150, Fidelity, I think it's about 75. Both Fidelity and Franklin are owned by a family, so and the family is connected with the investor. So we've been around for a long time. We've learned a lot of things. We've been through a lot of corrections. We know what can go wrong, and we've survived through that. And I think what the market's saying is, yes, it's not all about disruption. These guys, you've got something to add to this, and you could be part of helping us grow the ecosystem.
And we as an industry, actually, we do stick together. We actually lobbying to regulators, even though we are competitors. But when it comes to lobby a new regulation for a new blockchain or lobby a new product or a new innovation, we stick together in our industry forums and we go together to the regulator to really educate the regulator that this is a good thing for the investor. That's the strength on our industry because we are.
Well, an investor can move from one of us very easily.
Very easily,
We've got to be doing the right thing by our investors. There's nothing to stop you from moving from Franklin Templeton to UBS or HSBC. We've got to be good at what we do.
Exactly.
Yeah, that makes sense. I think asset management is complex and it has various dimensions of risk management that seem simple, but are really not simple.
No.
And the risk management systems and experience and thoughtfulness about that is a valuable resource that is in some ways underappreciated by the crypto community who keeps losing
I think we have
50 billion at a time.
They appreciate it after FTX, maybe.
Yeah, so there's something to that. In that vein, and we've talked about data, I think one of the key aspects of risk management is transparency and access to data and understanding the data of the underlying assets and systems. To the point of FTX, that was essentially a lot of data becoming known suddenly rather than gradually, and basically, the importance of transparency. So I think there's been some use of data in the on-chain tokenized fund world already successfully. I think there's a lot more that can happen there, and excited to hear your views about how data going on-chain can provide value in risk management and transparency and helping protect the investor. So Emma, how do you see that?
So I mentioned we brought Signum developed a token that is representation of our fund. So what we've done is that we work with Chainlink to bring the NAV of that fund on chain, so that basically the token can have that NAV associated to it. So then now the client can see that as part of their wallet. Risk management. So then if you want to bring utility to that token, you need the NAV so that you can use that token as a collateral. You can disclose that token on a public dashboard. Really, now this token is a proof of reserve. The fact that Matter Labs has a certain investment into our money market fund. So ultimately, that's how we use Chainlink to really, prove to the world that this is a real investment and a real NAV on chain.
Right, and that happens on a regular basis.
Oh yeah, every day.
Yeah,
every day the NAV is published on chain.
Yeah, more regular than some other systems that publish that. Much rarer, and basically, I think that's a good initial first step. But the tokenized funds have so many different pieces of data, even beyond NAV, and all of those.
I think we can bring so much more on chain. In my past, I worked as well on bringing ESG data on chain, or all the additional data that can be served to look at 360 of what is this asset about, right? So I think there is a lot of value of bringing the data on chain, so that you can bring so much more utility, like collateralization, as I mentioned, as well. You can add the carbon credit and the carbon footprint, etc., etc.
Yeah.
I mean, one of our views is that what we've been selling is you get a return, and that's it. But I think now people's social values, or what counts to them, they're going to see that they want to have an investment return, and they want to see the returns to things that they value. So whether that's ESG, they see that as part of the investment experience. It's not just the intangible. There's got to be some more tangible rewards.
It's knowing important risk management and other characteristics about the asset in a consistent, real-time way, basically. Makes sense. So Andrew, how do you feel the transparency and the data can play a bigger and bigger role in these tokenized funds and these on-chain assets?
Yeah, so I think the first step that everyone started with, the most important piece of data in the tokenized product first, is the share register. So that's why everyone looking at their tokenization structure had to bring that on chain in a way that sets the right foundation. I think now that some of these models have percolated in the market, and you kind of have a sense of different ways to tokenize the assets, the next big opportunity is then to look at the value chain around the funds, which is all essentially different pieces of data. And if the fund itself is a smart contract, each other piece of data is just another smart contract that can connect to it. So I think we already mentioned, NAVs, proof of reserve. That makes a lot of sense. That's one key aspect of, call it the investment, related data of the fund. I think there are probably other things around it in terms of, transactions where you think about, subscribing, redeeming in the primary market, other secondary market, kind of transactions that could exist. They all rely on, bringing more and more, data on chain. I think once you have that foundation of the register kind of there, then, all these other pieces can you can start experimenting with different ways to connect it and working with different, partners to see what's possible.
Right. So the tokenization contract, the token contract, is a ledger. And then after you've successfully done that, then putting more data about what that ledger, that specific tokenized ledger, that token contract represents, starts to, in your opinion, become more and more valuable. And do you see that being a way that maybe some funds differentiate themselves from other funds, and one fund proves a lot more than the other on a more regular basis, or conveys more valuable information about itself?
I think there's two kind of dimensions to it. There's one which is you're publishing the data for transparency, and that may be important for some use cases where you want more information available to make decisions. I think the other piece is data published that may be used by the ecosystem to add more utility to the product.
Right.
I think that becomes a more kind of commercial aspect, thinking about if we were to make this piece of data available, what more could somebody build essentially as like an if-then statement on top of it. So I think as a manager, it's kind of looking at it from those two sides and saying, depending on who you're building for and kind of what your partners might be looking for, then to think about it in these ways.
Right. You have a risk management component to the value of the data, and then you have a commercial value where more data can encourage greater adoption.
Because you've got programmability, which you haven't had with a trust, with a share certificate. You haven't had the ability to program it. So you've got this new capability that you haven't had before.
Yeah, if you can prove certain things about an asset, you can make it more composable with other protocols.
You've got to validate the movement of, to other parts of the ecosystem. Yeah, so. That's completely our view, that whole dynamic. Everything you just said about firstly managing the risk. Managing the risk is the initial value. That's very clear and simple to deliver. But then we have things that make certain tokens operate in a more programmatic way. So there's proof of reserves or NAV link or all kinds of smart data. But then we can actually make certain parts of the smart contract conditional on that data. So for example, proof of reserves can result in something called secure mint. And secure mint is when you use proof of reserves to mint more tokens or not, or to control redeemability. So it can serve a transparency value, or it can actually be embedded in how the token operates and control and manage risk right there in the token, so that some other system doesn't have to do that, because the token itself is now using the data to determine if it should mint something or not. Right? So this is the next stage beyond transparency. And then I think once you do that enough, you get to a world where you're putting in data that differentiates the tokens, and then there's other data that allows other systems to use the tokens, whereas without that data, that system couldn't use that token, or it's not set up to do that. So I think, that's the kind of progression that.
And the only other thing to add is then you need to have an audit trail, because you need to know what happened exactly at what point in time.
Edgar, please tell us what do you think? How does data and transparency fit into this? Please go ahead.
And it's immutable, so you've got a record of it that you can go back to if something goes wrong. So from our perspective, there's huge benefit. Huge
regulatory reporting.
The interconnectedness is that programmability and being able to get conditional logic that makes a change to something, whether that's a transfer of value, is a huge capability that we have not had.
Or liquidity.
And it's liquid,
Yeah.
So this is a massive transformation for us. And for us, we're trying to get our head around it, because these are things we've not considered before.
Right, so Edgar, you feel the same, that the programmability comes from the data, and that's a big component.
Clearly, think about liquidity, movement of liquidity. Think about scalability. Or if you want to serve a real user base, you want to give them the opportunity to benchmark you on real values.
Yeah, because we're in a dynamic world. We're managing assets, and markets move constantly. So you've got to, as those markets move, you've got to have conditions. There will be conditions that are met, and that has to create a change. And that the conditions may not just be from one source, they may be from multiple sources in order to satisfy that condition.
And you want all of them to evaluate that data without having to contact you, without having to sign up for an API for some data source.
Exactly.
Ideally, all the data that the counterparty needs to assess your financial product should be in the financial product.
Exactly.
Correct.
To the maximum degree possible.
Exactly.
Because it'll allow them to evaluate it, it'll eliminate risks and errors.
Exactly.
It creates a kind of unified golden record
Yes.
that they can all rely on in a reliable, efficient way. Does that sound about right?
Yeah, and I think in the current system, someone to do that conditional logic, someone has to actually associate the two. Whereas I think with blockchain, they are associated by default.
And there is where real reconciliation happened in the current environment, because by these differences you need to reconcile to get there. But if you can send it via
you don't
an
need to
order,
reconcile. It's right there.
it's right there.
We don't need to message each other to figure out what happened.
So
because we told the token what happened, then we can all see that it happened, and that's it.
Yeah, and there's the simplification in it. Yeah, exactly.
Yeah, there's huge benefits from that. So Andrew, anything to add about the value of transparency and data in its relation to fund tokens?
Bad.
Anything
Oh,
to add?
not like bad. No, I think the guys have done. I think we're saying we see that the data does provide the transparency, but not just from multiple angles. Whether that's your beliefs and values, it can give you more information about how it correlates to that. And we think it's forcing people, we've moved away from a model where we had these very reputable organisations overseeing us to make sure we did everything on behalf of the investor correctly, to the validation of changes happening on chain. We have to imbue trust with our clients, and the best way to do that is to be transparent. And I think to be able to show to your investor that you once a month this is what the assets are. We just don't think that's acceptable in this new world. It should be as Fidelity, and I commend them for adopting your proof of reserve, and that's something we're going to be doing soon. We know that that's important to our investors, to give them that transparency, and we see other competitors out there who are not willing to do that. And we're very we sit there and go, and both of us operate a money market fund. Full transparency, fully regulated. We have not moved up. Neither of us, our NAVs have stayed at 1 for 40. For us, it's 47 years. I think it's 45 for Fidelity. We will provide proof of reserves daily, not monthly, and we'll provide the yield. So we look at some of our competitors, the stable coins, who are saying, I'm not giving you any of the yield. I'll tell you the value once a month. I'm not regulated. I don't have any experience managing money. I don't know what's happening with your money between the last day of the month and the day before the next day of this month. I mean, we just see to us, that's just an anathema of the way that people can give them money, because you should be getting the yield, you should be getting the transparency. That's how you establish trust.
Yeah, I think all of these key data-driven capabilities and sharing the yield and proving things about how
it's not sharing. It's the investor gives us the dollar. It's their yield. It's not ours. We're not sharing it. We're giving it to them.
And that's why I think stablecoin issuer needs us as well, right?
Because to back their coin,
to back the reserve, to bring the transparency. If basically
you're the reliable provider.
Yeah, exactly. We know how to manage, a large pool of assets, right? So they need advisory from reputable asset manager in order to manage the reserves and how to report those reserves, right? So that's the opportunity. That's the challenge, but the opportunity at the same time.
And you folks providing more and more data differentiates you as a reliable provider of this asset management function, right? Because you're willing to prove more, but do better risk management, assure the investor, assure the regulator.
Both sides need to adapt, right?
And give you the yield.
And give you
the yield.
Rather than let a whole lot of ex-Goldman people go and buy bigger houses in Florida. We're giving it back to the people whose money it is. They're the ones who are taking the risk, not us.
I'm not sure if they know that, but you can keep that between you and the other asset managers. But that's fine. In any case, I think the other key component of all this, and I agree with you that the risk management is a deeply misunderstood and undervalued property. It's like security, right? It's like people, because we in the Chainlink community care a lot about security. Yeah, you care. Like when your neighbor's house blew up, you're like, oh my God, maybe I should have gotten like the gas regulator so things don't blow up. But until then, the gas regulator doesn't sound like it's similar with risk management, right? So I sense, I understand your point of view on that. But yeah, when these types of hacks happen, everyone values security. When there's asset management failures like FTX, they value risk management. So I'm completely on the same page with you on that. How much people even understand the risk they're taking by putting their assets with a stablecoin provider versus an asset manager versus someone else. That's not something I think people understand, and I think that if you can make that transparent and provide data to prove that superior risk management, then it can really differentiate the asset management industry strongly. So
there's an element of survivor bias. I mean, all four of us work for institutions who have been around for a very long time. We've seen a lot of market cycles. We've seen a lot of bad things go wrong, but we're still here. And survivor bias does sort of have, mathematically it actually is quite helpful.
Yeah, makes sense. In our final topic, because in our final the final question here, I think there's another dimension beyond data, which is interoperability, which is the ability for various chains to interact with each other in a secure, reliable way, move around value, move around data, be synchronized. So this interoperability problem, I think, is a pretty valuable and important problem. And I'm going to start from this end this time. So Andrew, how do you feel having a good interoperability solution or the problem of interoperability affects fund tokenization, the asset management industry? How do you see that problem being an important one or affecting the industry?
I think the main thing that's blocking us from offering more interoperability is regulations. We would see that a money market fund token should be a valid form of payment. Why does the merchant have to pay Visa 3% to do a transaction if I can demonstrate to you on chain that I have the assets and I can transfer them to you immediately? So I think from our perspective, it's really regulation that is stymieing the interoperability, but we see that there's no reason why you should not have a yielding form of payment that you use for your payments, why you should have, and I think a merchant, why they should have to pay to validate you have the money when
when you say regulation, what do you mean? In what sense? Like the regulator won't allow the asset to move between chains?
No, I think there's just still some issues around security tokens in a number of countries that it's not clear that they are.
But is that an issuance issue, or is that an interoperability issue? Would be like I have my token over here, the asset, you have your form of payment over there, and you need to send me your payment in order for me, and then I need to send you my token. That doesn't have as many regulatory issues. That seems more of a technical challenge.
I think at this stage, from our perspective, it's been a regulatory challenge to have a token that is accepted as a form of payment. We can do it through an intermediary, such as a mobile wallet.
So for the counterparty to even accept your desired form of payment, it needs to meet certain regulatory clarity levels, and in that sense, it's not able to be accepted. And once it's accepted, then there are some technical challenges, but that the main challenge, the initial challenge, is how to make it accepted as a form of payment.
But it will be accepted. I mean, Hong Kong is probably where it's going to happen first with the Hong Kong dollar, and then I think on us, what will be required from us is to have the liquidity provided from the funds, because as I said before, we're a 9-to-5 business, but we are moving to 24/7. But if you want to move from our fund token into an EHKD to go and buy a soft drink, that should happen, seamlessly. And that's where, because your money should be working as hard as you do for as long as possible before you go to spend it or transfer it to another party.
Makes sense. Thank you. Edgar, how do you feel interoperability is going to play out and its role in connecting chains and helping asset management and AUM and those things grow?
I do believe that we are at the beginning of first understanding, like, for example, as you said, Andrew, Hong Kong dollar in the Hong Kong environment. And I think when the adoption of that happens, then why is it limited to Hong Kong? Why can't I use that when I go to Singapore and pay in Singapore, to another country and pay in another country? I think this will come as the maturity of the market reaches that point. And when it reaches that point, I think
digital money, digital investments.
That investors are going to ask for, we want to go further or we give it back. So I do believe there will be a push coming as we are seeing that not only Hong Kong thinks about the Hong Kong dollar, other regulators think about the same way. And I do believe that this intercompatibility will come because you want to use it in multi-markets. Why should you restrict yourself?
Yeah, you want to be all
only for one market. I think we are just at the beginning of this journey.
So you see stable coins, central bank digital currencies, tokenized funds, in Andrew's case as a form of payment, which is an interesting idea. You see that beginning in a geography like Hong Kong, but then getting reused pretty rapidly in other geographies as a form of payment, as an asset, because it's so portable, right? So it's just, I have it in my wallet over here, and I need to transact with someone over there. Why can't I transact with them over there?
Yep.
I already have it in a wallet. I thought the point of this was this portability. And you think that portability is going to take on kind of a life of its own.
And I think the ECNY and the EHKD, Hong Kong's role in the Greater Bay Area, where you've got 3 currencies operating. You've got the Hong Kong dollar, the Macau, what is the Macau money called? I've forgotten now.
I don't.
But we'll call it the Macau dollar, and you've got the Chinese yuan.
Yeah.
But people will move between Shenzhen, Hong Kong, Macau, Zhuhai, and Guangdong. And I think this is going to be the model for China. APACxJ, thank you.
Thanks.
So I think this is why it's such a market where it's going to happen. And you've got, China is very aggressive and very advanced on blockchain, far more than anyone else in the world.
Yeah, in mainland China, within that kind of closed universe, very much focused on adopting it for that world.
But this is that world. I mean, Hong Kong is part of China. There's no doubt about that. We are in China.
So you think
the Chinese own this place, not the British. I'm an Aussie, so we're quite happy about that. We know what it's like. So we know what it's like to be owned by the British.
Thank you for clarifying that interest. So now that we're clear on that key point, you're saying that the mainland China blockchain system adoption will filter into Hong Kong blockchain system adoption.
There will be interoperability.
Why do you have to have friction moving from, if I'm in Shenzhen today, say if I want to go up there, and have a nice meal, why do there's friction now?
Right, and all of that will need rails and interoperability solutions.
And that's coming.
Yeah, makes sense. Andrew, please tell us your views on interoperability and cross-chain and how that's going to affect AUM.
Maybe I take it more from a practitioner perspective.
Please.
And so I think about it more from, interoperability is almost inevitable that we're going to need some kind of solution for it, because when you're structuring the asset, the choice of the chain that you put it on, the asset might have some requirements in terms of the properties of the blockchain that you're using. And different, products can be structured, more on chains with properties that are more permissionless, but maybe permissioned, and you have others that probably won't be permitted to be on networks that look like that. And so just as a practical matter, you're going to have all these different structuring kind of decisions made that are going to result in different chains being used to ultimately store the kind of the register for that piece of value. Notwithstanding that, then if we talk about the data and the life cycle, some of those operational processes might benefit from being on chains that have different types of security properties than the ones that you might be holding the register. So I think just, very practically, there are a lot of people making different design choices, and these are going to eventually need to be connected. And I think that's where, the regulation will almost drive the design of these assets to be a little bit different. And so then getting to the second point on the technical solutions, then there has to be some thought about how to kind of design the technical solution to allow for this data that represents different things to kind of be brought together. And I think this is where maybe it's not the first step. Again, everyone thinking first right now on what's the right foundation to tokenize if you're talking about funds, the share register. But once you start having kind of newer use cases pop up, I think it's just almost inevitable that you have to start thinking about different chains, different purposes that they serve, and how to kind of link it together.
Right, and you said something interesting there where it was the movement of value and the synchronization of data, right? So you see that you'll have many chains and there'll be movement of value, but then data will also need to be synchronized in some useful kind of unified way across a few different chains because all of those chains relate to that asset somehow. Is that, do I understand you correctly?
Yeah, so not only does the data need to kind of be synchronized across the chains, but there might be some processing that you do around that data that is more efficient to do on a chain that has slightly different security properties than another.
Right.
So even kind of as you start to expand the utility and the use cases, so not just about the share register activities, but the stuff around it, there's going to be a lot of these people making design choices to put those kind of actions.
Yeah, there's all this data computation, interoperability surrounding the tokenized fund, and as the tokenized fund starts to live on many chains, that complexity of keeping that synchronized grows.
Yeah,
right.
For sure.
And so something has to manage that complexity in order for that tokenized fund to work.
Yeah.
I wonder what that is. What could that be? But we'll see. I have a feeling I know though. So. Emma, how do you feel interoperability, cross-chain fits in with fund tokenization, AUM, these types of dynamics?
Sure. So, I think you're going to like the answer. That's why we're using Chainlink, right? So we don't have to worry too much about that.
I do like the answer. That's the perfect answer. That's perfect.
So ultimately, that's why we're putting the NAV on Chainlink, so that ultimately, the clients, being Signum, APACxJ, or others, ultimately, when they develop a token that is a representation of our fund, they can use the NAV, from Chainlink. But ultimately, right now we are, from our perspective, even from a data point of view, if you're using Chainlink, we're a bit one-to-one, right? We have Signum, we have APACxJ, and then we have the others in the pipeline. So we are really trying to have the critical mass of clients so that at some point, ultimately you will have to have this interoperability. But today we're still building, I would say, the assets on chain, and you need to have enough of that to justify a large interoperability framework. So I would say, in the years to come, that will be more and more important. Yeah.
Yeah, it makes sense. So basically, as the value on the different chains, as the value in the funds that you manage grows, interoperability.
In fact, that today we didn't mention that, but today we have digital twins. So they are a twin representation of a traditional fund. But ultimately, we want to develop digital native funds. So when you have digital native funds, you want to be chain agnostic. You want to settle in a stable coin, in a tokenized deposits, in any form of money on planet Earth. Be agnostic so that I can serve as many clients as I can ultimately, right?
Right, that's another dimension of interoperability, is the liquidity, right? So you have a tokenized fund, you release it on chain A, but the liquidity that can access the fund is on 500 different chains. How do you release a tokenized asset and a real-world asset in a way that it can accept payment from hundreds of chains, public or private, and in your case, accepted in a compliant way, right? So a compliant form of payment from those hundreds of chains.
Yeah, in the case of money market fund. But let's say it's not a money market fund, for example, like a really super high risky instrument that a payment platform might not accept a merchant, for example, I don't know. It's still valid, right? You still need to have the distribution network through, that and the liquidity.
Yeah, and I think that's part of what interoperability solves, is the ability to create that distribution. And the place you're distributing it to is more like the chains, right? The different chains are their own environments with their own markets. And if you don't have a way to connect to those chains, to allow those markets to buy into your tokenized asset, fund, whatever, you have a smaller market, which is not the reason you're doing this. You're doing this to have access to the largest possible market, which is something that interoperability creates, if it works well.
Correct.
Great. So very thoughtful conversation. Appreciate all your candid views that you shared with us. Thanks for all the feedback and the great collaboration. thank you for being here with us.
Thanks for having us, Sergey.
Thank you.